Hey everyone, welcome back to the channel. Today we're diving into a topic that often confuses traders, the difference between margin trading and leverage. If you've ever wondered how traders can control positions much larger than their account balance, or what the real risks are, you're in the right place. By the end of this video, you'll clearly understand what margin trading and leverage mean, how they work, and how you can use them safely to maximize your profits. Let's get started and break down these essential trading concepts step by step. Start with margin trading. Imagine you have $1,000 in your trading account but want to trade $5,000 worth of Bitcoin. With margin trading, you borrow the extra $4,000 from your broker or exchange. This borrowed money is called margin. However, you must always keep a minimum balance known as the maintenance margin to avoid having your position liquidated. Margin trading lets you control bigger trades, but it comes with higher risk. If the market moves against you, you could lose more than your initial investment. Plus, exchanges usually charge interest or fees on the borrowed funds. So while margin trading can boost your buying power, it also increases your exposure to risk. Now let's talk about leverage. Leverage is simply the ratio of your total trade size to your actual capital. For example, if you have $1,000 and trade $5,000 worth of Bitcoin, you're using 5x leverage. This means your profits and losses are multiplied by 5. It's important to note that leverage itself isn't borrowing money, it's a measure of how much you're amplifying your trades. Margin trading uses leverage, but not all leverage trading involves borrowing outside funds. The formula is straightforward. Leverage equals your total position divided by your own capital. So $5,000 divided by $1,000 equals 5x leverage. Leverage can be powerful, but it also magnifies risk. Let's compare margin trading and leverage side by side. Margin trading is all about borrowing funds to trade larger positions, while leverage is about amplifying your exposure to the market. With margin trading, you need a margin account and may pay interest or fees on borrowed money. Leverage, on the other hand, multiplies both your gains and losses and can be used in margin trading or derivatives trading, sometimes without direct borrowing. The key takeaway is that margin trading allows you to use leverage, but leverage can also exist in other forms of trading. Always remember, both tools increase risk, so use them wisely. Let's look at a real example to see how leverage impacts your results. Suppose you have $1,000 and use 5x leverage to buy Bitcoin. If Bitcoin's price rises by 10% without leverage, you make $100. But with 5x leverage, your profit jumps to $500. However, if Bitcoin drops 10%, your loss is also multiplied. Without leverage, you lose $100, but with 5x leverage, you lose $500. This shows how leverage magnifies both profits and losses. That's why risk management is so important when trading with leverage or margin. Always use stop losses and never risk more than you can afford to lose. Wrap up: margin trading means borrowing funds to trade bigger positions, while leverage is about multiplying your position to amplify gains and losses. Both can be powerful tools, but they come with significant risks. Always trade responsibly, start small, use stop losses, and never risk more than you can afford to lose. Understanding these concepts is the first step to trading smarter and safer. Thanks for watching and happy trading.